Okay, so before we go into learning any strategies and everything, right? Guys, just admit everyone into the lobby. I see there's 15 people. No one's admitting them in. Please just admit everyone into the meeting, please.
Your ID and everything was there?
Sorry. My ID. Okay, I think that person might have talking to someone else. Okay. Okay, so before we learn any strategies, right? The most important thing is understanding market structure, right? This is the basics in trading. This is the backbone of trading. You gotta understand how the market moves before you go into anything. Right. So the first thing, just look for this, right? This is something that you guys need to understand, right? So market can move in three ways. It can move in an uptrend like this. Okay, that's your uptrend. Most of you already should know this by now. Okay, uptrend, and we're creating higher highs, higher low, higher high, higher low, higher high, higher low, right? In the downtrend, it's simple. Okay, we're creating lower lows and lower high, lower low, lower high, lower low, lower high, lower low, lower high, right? That's your downtrend. Okay, so that's your uptrend right there, your downtrend, and we also have our God, no one's admitting the name. Okay, then of course you have your consolidation, right? Where the market moves sideways. Before it picks a direction, right? So this is your. Okay, sorry, I just want to see something. Sorry, I think I mistakenly deleted something that I was supposed to delete. Yeah, I wasn't supposed to delete that indicator. Okay, but okay. So again, I said higher highs, higher low, higher high, higher low, higher high, higher low, higher high, higher low, right? That's your uptrend. Then I said your downtrend like this, right? Lower low, lower high, lower low, lower high, lower low, lower high, right? That's your downtrend. And I said, okay, then your consolidation where market's moving sideways. It hasn't really picked a direction, it's just moving up and down between the support right here and your resistance that's kept there, right? Okay. Support right here, resistance, right? Okay. Now the next thing that you need to understand is when the market, say for example, we in an uptrend like this, right? We are moving in an clear uptrend. Okay, we are creating higher highs, higher lows, higher high, higher low. When the market creates a new high. Okay, so when we had the market just moving in an uptrend like this, and it took out this high. See, you had the high here, and then it created a new high right here. Once it took out here, that's your break of structure. Right, break of structure, break of structure. You see when the market creates a new high, call that a break of structure, right? Okay, one thing. Right? The new high got created here. Okay, we took out the previous high. That's your break of structure. Again, new high, there's a high created here, right? Took that high out, break of structure. High created here again, took that high out, break of structure. Right? Simple. Okay. Now, and similarly on a downtrend, of course, the market isn't going to move like this. It's not going to move in a straight line, right? It's going to move all funny, not like this. Okay. And of course, in a downtrend, we have the low here gets taken out, break of structure right here. See there? That low that got created the low, that high creates a new low, boom, new low, low. Right again. Low gets created here. Low gets created, retraces a bit, and then boom, takes out that low, break of structure. And then we push down, push more down, right? So simple. That's a so what I went over so far. This is called a higher high, higher low. Then once a new high gets taken out, break a structure. Higher high, higher low. Break a structure occurred there. Higher high, higher low. Break a structure. Higher high, sorry. Lower low, lower high. Break a structure. New lower low created. Lower low, lower high. New lower low gets created. Break a structure. And that's basically it, right? And I told you guys that this here is called a resistance, right? Markets struggling to basically break this. Okay, markets struggling to break that. That's your resistance, and that's your support, right? So this is usually between two ranges where market is. Before market can pick a direction, it has to be it goes through this, right? Okay. So now that we went over this, the next thing I want to show you guys is understanding what an FEG is. Okay, you guys probably heard of this. You might know, some of you already know this, what this is. If you were with me for some time, you'll know that I like to use the FEG for a lot of my entries. Most of my entries that I take are done with using FEGs. Okay, so if you go on to, okay, I just understand that drawing tool. Here we go. Okay, so if FEG is basically a three candle formation like this, right? It doesn't matter the size of the candle. Doesn't matter if this candle is big, this candle here is massive, whatever. Sorry, it's supposed to be like this. All right, it's a three candle formation. 1, 2, 3. 1, 2, 3. Then right, and then you'll see. Okay, so what's a fair value gap? Basically, when you have a three candle formation like this, and then you'll see a clear gap, okay, gets created, right? Okay, so let me just draw this wick here. A clear gap gets created between the three candles. Okay, 1, 2, 3. It's usually on the it should be on the second candle. Okay, so it doesn't matter how big the fair value gap is, how small the fair value gap is. Okay, a fair value gap is a fair value gap, right? And some people can have the misconception that the bigger the fair value gap is, the better it has to survive. Okay, sometimes the small fair value gaps can be just as strong. The bigger fair value gaps can also fail very easily, right? It all depends on the market, how the market will react in it, right? So this is an example of a fair value gap that I just drew. That's a bullish fair value gap, right? Moved up. Now, an example of a bearish fair value gap would be if the market moved like this. I'll just make this red for you. That's your bearish fair value gap. Let me just draw the wicks here. Okay, now this gap that's here, I got created here, you see this gap? You see the wicks aren't overlapping, right? The wicks aren't overlapping, so now the wicks don't overlap and it's a gap here, right? Okay, yeah, it does overlap, there it does overlap, but there's still a gap here, right? This wick here, is it coming like this, right? If this wick had to create a wick like that, right, a down wick like this, that's not a fair, then this wouldn't be a fair value gap. This would be invalid. This is not a fair value gap, right? Okay, so any three candle formation, okay, it has to, for it to be a valid fair value gap, has to have a gap here, right? And another thing is, all we worried about is the middle candle. Okay, say for example, right, we create a down candle like this, right? Let's just say sorry, this is a bearish candle, right? Like that, right? Right, say for example this here, this is still a valid bullish fair value gap, right? This is a bullish fair value gap. It doesn't matter that this candle here is red, this one is green, right? What I'm worried about is that this here, that let's make this a bit smaller, right? That this candle here is what I'm looking at. Okay, this is basically going to tell me if this is a bullish fair value gap or if this is a bearish fair value gap. I'm looking at the middle candle. I'm not worried about this candle color and this candle color. I'm worried about the middle candle, right? So similarly, if this candle here was green, right? If this was a bullish candle, right? Similarly, then this wouldn't really matter. All I'm looking at, and of course the wick needs to be smaller, right? All I'm worried about is this candle here, right? Is it bullish or is it bearish? Now this is bearish, right? So it's a bearish fair value gap. And also, if this candle here, for example, is also green, right? If this candle here is also green, all I'm worried about is this candle here, right? This can be bullish, this can be bullish, but this middle candle is bearish, then it's a bearish fair value gap. The middle candle is what I'm looking at, right? So how these get formed is when market moves too quickly in one direction, okay, and it leaves an imbalance in price, right? Remember, right, for there to be a buyer, there needs to be a seller. For there to be a seller, there needs to be a buyer. Okay, simple supply and demand, right? So there needs to be an equal amount of buyers and sellers, right? But in this case scenario, there was more buyers than there was sellers, and then here there was more sellers than there was buyers, right? Okay, so that's basically fair value gaps, right? Now, what would happen if, let's say, for example, we create this, right? Market starts moving like this, right? Okay, and market closes below here, right? So went up, and then we decided to go down, right? And market closed below here. Now, this is your inverse fair value gap. This is what you call an inverse fair value gap. When the market goes up, it's a gap here, then goes and market fills the gap and closes below here. Now that is an inverse fair value gap, right? Okay, so you need to see the candle must close below this area. So if the candle closes like this, right? Let's say, for example, candle closes like this. Okay, it's this wick here. Now this is not a proper this is not going to be an IFVG, right? It's still going to be a valid fair value gap, right? The wick, even though you need to see a candle close, you can't just see it wick through and then close above there. That's not valid. Or even if it closes inside the gap, yeah, right? If it closes inside, that's still not valid. Okay, you need to see a full candle close above. Sorry, below. Sorry, below. Right, you need to see a full candle close below for that to be an inverse fair value gap, right? So what we should be expecting if you want to look for sells, right? You want to look for market to go and close below here like this. It must come down close below the fair value gap, and then you can expect price must be going down, expect price to go lower, right? And similarly, if market was doing this, we did have this fair value gap here, and then of course we inverse it this way here. As it's a bearish fair value gap, and then we say, for example, market just pushes above it, and there we go. So now that's an inverse fair value gap, right? You had market create this candle here. You can even say created like another candle like this or something, and then right. You can say that's your fair value gap right there, inverse fair value gap, right? Now, when the candle created like this candle here got created, right? Now this isn't the inverse fair value gap. Let's say, for example, it wicked here, right? That's not an inverse fair value gap. What I want to see is market close. So this now became a valid inverse fair value gap. You need to see market close above it to be a valid inverse fair value gap, right? So this, like I said, this is not valid, but this here, that's valid, right? So I hope you guys so far you understand what's happening, right? This is pretty simple. It's not something that you should be breaking your head for. It's simple. And I will give you guys a video as well, the recording of this lesson tomorrow or Tuesday, whatever. When I get a chance, I will upload this onto YouTube or something, and you guys can go watch it, right? So now let's look at examples, right? I showed you guys what an example of a uptrend, right? Okay, let me just look for a clear uptrend somewhere. Right, here we go. Okay, here's an example of a downtrend, right? You can see clearly markets in a downtrend. How we know this? We see that the market's creating new lows, right? We see the market's creating new lower lows, and of course we're creating a lower high, right? So if I bring my tool, draw into my path tool right here. Here we go. Lower low, lower high, lower low. You see our market's creating new lows, right? Lower high, lower low, lower high, lower low, lower high, right? And of course, we had a bit of consolidation right here. As you guys can see, what I was talking about basically between the support and resistance, and then market chose the direction, decided to go lower, okay? And from there, market decided it wants to push up higher, okay? So that's basically it, right? And then from here, what happened? We started creating higher highs and higher lows, right? And like I said, the market's not going to move in straight lines, but you can kind of have an idea of what the market's doing, right? Right? You can see, right? Lower lows, lower consolidation. Then we broke into had a market structure shift, and we created an uptrend, right? Clear uptrend. New lows are being created here. New highs are being created here, right? So that's basically your uh your trend, understanding what the trend is doing, right? So now, how do you put the fair value gap and the understanding the market trends together, right? And also, what we're adding into this is time, right? You're adding time plus the market structure, and you've basically got and of course a fair value gap, and you've basically got yourself a simple strategy that you can use pretty much every single day, right? So also, let me show you guys examples of a fair value gap. Pretty simple. Here's a tool. Yeah, there we go. Now, yeah, right here, fair value gap, right? And similarly, what I told you guys is this is a bearish candle. Sorry, bullish candle, bearish candle, bearish candle. But this here is still a valid bearish FEG, right? Until we broke above here, right? Look what happened. We broke above here, inverse this candle, inverse this fair value gap, and what happened? It pushed up, right? Simple. That's the inverse fair value gap is one of the best reversal tools that you can find. Okay, if you want to look for market, look how the market reverses when it inverses a fair value gap, right? Look here, there's a fair value gap here. What happened? Market inversed it, pushed up, right? This is one of the best reversal tools that you can find. Okay, so you can use the inverse fair value gaps like that. And remember, the strategy that I'm teaching you guys can be used throughout the day, but we are just using time. We're just adding in time to make it easier for us, so you're not looking on the charts the whole day, right? So you can see this is working, this strategy, right? That okay, what I'm showing you guys of the inverse fair value gaps can work throughout the day, right? All these fair value gaps get inverse, right? And look what happened, pushed all the way up. Simple, right? Okay, and if you look here again, there's a fair value gap there, inverse this gap here, right? And we created a new gap right there, and we created that candle there. And look our market. Of course, I'm not going to take any trade unless we push above here, right? That's your fair value gap, your inverse fair value gap, right? And similarly, if you wasn't able to spot the inverse fair value gap, you can see there's a fair value gap here, a bullish fair value gap, right? Look how market tapped into it, respected it, and pushed up. Okay, so that's your chance for you to take a trade there. If a market respects the fair value gap, you can take a trade, and pretty much it's right. Look here again, fair value gap here. Look how market reacts of it, right? Okay, so the market didn't tap into it, but here again, right? This is how market inversed it basically. This is a valid inverse fair value gap, right? Because why this is a valid inverse fair value gap is because market closed below it, right? It inversed it, and then of course it pushed up. Looking for example here. Okay, I see one here, right here. Right. Okay, so here we had the breaker structure occur right there. Okay, breaker structure occurred. and we tap back into the fair value gap where you're going to take a trade. Your trade will be when you break above here, right? Once you close above here, that's your chance. You can take your trade, right? Okay, so this is your okay. So once we were in an uptrend, right? So how can you spot when the market's also turning, right? So we're in a strong uptrend, basically, right? We're in a strong uptrend, right? When the market closes below this area right here, okay, you can say that this can be basically like your resistance area, right? Okay, even if you want to be more precise, maybe you can even draw it maybe even here or something, right? Your resistance, basically, market's basically coming in this area and just rejecting it. Okay, so what you're gonna do is wait for market to close below the previous lows that were created here, right? So we're in an uptrend, we consolidated. We're gonna wait for market to close below these lows here, right? Once the market closes below these lows, you gotta look for, of course, your fair value gap, right? And then you take a trade off there. Right, pretty simple. But okay, so we're gonna go with the fudge strategy, right? This is what we're going over right now. Market structure shifts are also important if you want to catch those reversal trades. Look how what happened, right? We created the market structure shift, we created the fair value gap, and look how we reacted off the fair value gap, right? Sold. Okay. There's certain other, if I'm going to be trading this, is certain other things that I like to pair the fair value gap and market structure shifts and all of this too. Like I would look for liquidity sweep, some sort of liquidity sweep, and then of course then I'm looking for, of course, a market structure shift on the CFA value gap form in it, so that I don't just get baited into taking the trade. I want to look for the fair value gap, and it mustn't just be. Sometimes you can just, if you market just closes below the previous low, right? It just might just close below the previous low, but there's no fair value gap there. Now that's most likely going to be like a liquidity sweep or something, right? So if you look here, right, we close. Can we just look here something? Okay. Okay, where's some example I can use, right? Okay, I don't really see example. Okay, so okay, as an example, right? So it's just not the best example that I would like to use, but you see this low that was created here, right? Market went and took out that low, right? But when it took out this low here, it didn't create the fair value gap here. There is a fair value gap here, but there's no fair value gap once it broke here. Once you see this break below the markets, below that previous low, that's where you're gonna see the fair value gap form here. Right? And then of course what you want to do is you can either take your trade straight off like a FEG or something, right? Wait for market to close like below FEG once you break below there, and then you can take your reversal trade, right? But like I said, let's go over the further strategy, right? So I showed you guys the how we trade with FEGs, how you guys can use FEGs, basically inverse fair value gaps and all of that. But now let's actually look at the market, right? So first thing first with the fudge strat, you've got to work with the trend, right? With most strategies, you've got to work with the trend, what the trend is doing, right? Unless you see some sort of market structure shift, then you can obviously you can try and catch the reversal of it, right? But in this case scenario, you do see a bit of a, if you look at before 6 o'clock, right? We did have a break below here. Then we started pushing a bit of consolidation, but we still look overall bullish, right? If you look at 6 o'clock, let's look at 6 o'clock, right? Look for 6 o'clock to come. This is 6:25. Okay, so we went bearish a bit here. You can see we went bearish a bit. Now, where we are on the enter off is, of course, of a fair value gap, right? If I look here, I don't see any fair value gaps here. Do I see inverse fair value gap? Okay, 7:30 came, right? If you look here, the inverse fair value gap. So you're either entering off an inverse fair value gap or normal for a normal fair value gap, right? And I see the normal fair value gap right here. And what you want to do is simple: wait for market to break above, right? And you can take your trade right there. Once market breaks, closes above, where was it here? Right there. Once market inverses the gap, you can take a trade. You can go with your stop loss below the previous low, just there. Okay, or if you want, you can also go below the fair value gap here. So if you want to go for more tight, which can be bit risky there. If you look there, if you go there, it's still a bit small. It's only about, how many pips is this? This is about, it's about 80 pips or so. Oh, what's the price here? 4577. Yeah, it's about 80 pips, right? So you can go below, maybe below this gap, this fair value gap here, if you feel like it's maybe too big for you, right? And what your target can be is you can go for like your 100 pips. So my entry is at 4576. I can go 4586. And remember, your stop loss must be at least, your TP must be bigger than, of course, your stop loss. You can't have a small stop loss. Sorry, a big stop loss that's bigger than your TPs, right? So you can also target 100 pips and then just leave a runner once you hit your full TP. So if I were to maybe take this trade, or maybe I look at maybe targeting those highs right there, right? And do we actually end up hitting it? We do eventually hitting it without getting stopped out at break even, right? So what I would recommend that you guys go at a break even, right? If you go into maybe like 50 pips profit, right? So 4576, if you're entering there, 4582. So 4582. What I would recommend is you close at least half your trade. I always tell the people, the students, close your half your trade at 50 pips, right? And take half your trade and close it, go break even. Right? So if market does decide to reverse here, you know you're covered basically, right? And if it does go and hit your stop loss, you're covered, right? You know that I did take some profit. I didn't just wait for market to take me out. 50 pips is a decent amount of profit. On a 0.01, I think that's at least like 99, like close to 90, 100, around that area on a 0.01. So it's decent profit that you can make, right? So this was just an example of the further strategy. Simple. We had a fair value gap get formed here. We were bullish, as you can see. We broke above this previous high right here. So we are going into 6 o'clock. We are bullish, right? And of course, there wasn't any like bearish fair value gaps that got formed, right? Like here, once we did break above here, this is confirmation that we're gonna be bullish, right? Once it broke above here, that's a bullish example, and we did form a fair value gap here as well. So what you do wait for, and you wait for market to inverse that gap, and you take your trade in simple, full TP smashed, right? And yeah, on this trade you would have gotten about 2000, 2004, no, 1000. What's the price here? 4601. So that's about 1800 points, I think. Wait, sorry, wait, 424. Yeah, so it's 2400 points. That's about 240 pips. It's a lot, right? On this trade here. If you so okay, so most likely I think a lot of people will have probably gotten up break even here, right? That's pretty much it there. But if you look here, there's another entry point that you could have entered here once you entered off here. This fair value gap. Once you see the market, see how market reacted off it. Didn't it respect? It looked like didn't it look like it's respecting it, right? It looks like it's respecting it. Yeah, basically taps into it. And there you can go. You can get another. How many pips there? Another what? 200 pips basically. There, right? About 220 pips. That second buy gave there, right? So that you can take your trade there. Because what happened here, right? We had a bit of a liquidity sweep here. We had the break above here. Okay, we had basically the breaker structure. Wait for breaker structure to occur. Then once you had the breaker structure, wait for a fair value gap formed. Take your fair value, tap into the fair value gap, boom, tap into it again. There again, there. Simple. Once you see market respected, right? Once the market respects the fair value gap, that's your chance to enter. Alright, so this was Monday, okay? And then again, yeah, I gave a chance here again, right? At 2 o'clock. See how market respected this fair value gap pretty much the entire day. Okay, and if you caught this trade here, you could have probably held it the whole entire day till 6 o'clock. 4 hours you would have held this whole trade here. Till what price was that? 4629. Okay, that's basically what 50, 60 pips. Okay, about 60 pips. 600 pips, sorry. 600 pips. Wait, yeah. Yeah, 600 pips, yeah. 600 pip trade right there. Okay. Massive trade. So and you can see how the market reverses, right? Once we had the breaker structure, once we had the market structure shift here, this is a valid market structure shift. Why? And wasn't just a liquidity sweep, is because we had the fair value gap on the leg of the market structure shift. So this here is the leg of the market structure shift, and we see the fair value gap got formed here, and then look how market failed to break above. Okay, so that's your chance to enter again. Take sells. So take in your sells. Target could have been maybe these lows right here. This New York open lows right here. That could have been your target. Stop loss maybe above here if you wanted. Or you could even have stop loss here if you want like a more tighter stop loss. That's probably like the most tight you probably get. And yeah, and there's your trade there. There's a couple of trades you could have taken in this day. Okay, so yes, look at this is Tuesday, right? This is last week Tuesday, and I'm looking at buys, right? So if I'm looking at buys, unless I see like a market structure shift, right? So yeah, we can see there's is a small market structure shift occurring right here, and because we broke below here, right? Now the next thing that I'm going to look for is some sort of fair value gap. Okay, so this wasn't really a valid market structure shift that I would probably liked, but so this is something that I wouldn't look at a sell here, right? So let's just see any valid fair value gap, a fair value gap formed right here. Now the next question is, right, do we respect this fair value gap, right? We don't respect it. Okay, so do we take the trade here? No, we don't take the trade, right? You want to wait for market to tap back into it. The only time that you can enter straight off is off of inverse fair value gap, right? You can enter as soon as you don't need to wait for the retest, right? I would, for fair value gap, a normal fair value gap, I want to wait for the retest for then I can take my trade. For inverse fair value gap, as soon as the market closes here, I will take my trade, right? So yeah, we created this fair value gap here. We closed below here, right? I want to see a bullish candle, not this bearish candle right here. Okay, we want to wait for this candle to close, and then what happened here, right? We created a bearish fair value gap here. So now what I want to see is market give me an inverse fair value gap, right? Sorry, I want to see market create I'll take a trade here, right? So we can take buys here, right here. And of course, you can see that this trade didn't play out, but the idea is still basically there, right? We went for this. If I did have to take this trade, either would I've went to the stop loss about here, maybe somewhere around here at this previous low right here, and TP would have been how many pips is this? TP would have been probably about 1,000 or so points, right? For somewhere there. No, 1,000. Oh, wait, sorry about that. 4,000 entry, 4,599. So it's really nice. Yeah, it's about there. That would have been TP basically. I think that's way I can see it got stopped out there, right? And if you look here again, what happened here? We had a proper market structure shift, right? Why this was a proper market structure shift was because we had this fair value gap here. Right, so obviously the entries that we're looking at is obviously 6 o'clock to 8 o'clock, right? Now I see a valid entry right here again. Okay, so of course I'm not going to enter straight away. Take this, delete this. Okay, you can, if you're looking for a recovery trade, you enter once you see market break below here. You don't want to enter here in this gap. Okay, so this was a valid market structure shift right here, right? Why? Like I said, there's a fair value gap here. Formed a fair value gap on the leg of the market structure shift, and we had a liquidity sweep of these highs as well, so that's pretty valid, right? Once we broke below here, take your trade, and you could have targeted even opposing liquidity here easily. You'd have recovered your loss that you took here, right? So I took a short position here. Let's say can go stop loss on that fair value gap, the candle fair value, the middle fair value gap, and I can take my trade, maybe targeting these lows right here. Right, easily you should have recovered, right? Then again, we had, of course, your market structure shift occurred right here. Then you can take your trade of a fair value of an inverse fair value gap if you wanted to. Easy. I mean, obviously we swept these lows, so your liquidity sweep pretty much checked. And there's inverse fair value gap, broke above, tapped back into it, and look what happened. We pushed up, right? Okay, so let's look at the Wednesday. Let's see how Wednesday played out. Okay, so there was plenty of trades if you use the chart that I'm showing you guys. Wednesday, okay, we can see we clearly bullish, right? We clearly bullish. Let's delete this. 5:30 game. And of course, all of this is done on the 5-minute time frame, right? All of this in the 5-minute time frame. I see a fair value gap here. Look how market taps into it, 6:30. There's your trade. Once we close here, take your trade right there. Stop loss, you could have went maybe below here. If you want to go for a tight one, or you could have went there. So you do have if you want to give yourself more breathing room, you can put your stop loss there. TP, I can go. We can go with maybe one. What how many pips is this? What's it for? 4627, 4637. I'm looking at, right? 4637. That's basically it, right? And this trade, by the way, I was given this. Well, I did give you guys a free signal for this. And remember, I was a bit shocked at this candle right here. I don't know if you guys remember this. I was like shocked. This was on Wednesday morning. I thought this was like news or something like that. Those who are in the signal group, the signal was given to you guys. Right. By the way, with the signal group, we only lost once with gold this week. With regards to a signal once, and that was on a Friday. So the entire week we were eating this entire week. So okay, so this loss that I showed you guys here, we didn't take that loss even. I didn't even take this loss. Okay, but we did take this trade here. We cooked with this trade here, right? And as you can see, right, what happened here, broke below here, market structure shift occurred right there, and what happened, tapped into the fair value gap. You could have taken your trade multiple times, tapped into it. Okay, once it broke above here, that's your inverse fair value gap sign that we're going to be reversing, and look how we reacted there, right? And then market, of course, EC gave this. I think he gave this sell somewhere around here at about 10 o'clock. Look how market sold off here. Sold off pretty crazy, right? The sell was given to us in the signal group. We sold off here by Ismail. He gave the sell. Cooked, absolutely cooked it there. Right. Let's look at the Thursday. Okay, Thursday. Look what's happening. We might have a bit of still a bit in a consolidation mode here. We did break about. We failed to break these highs here. So let's just see for fair value gap to enter off from, to enter sells. Okay, so that's 6:30. What time is this? Okay, 6:20. I personally wouldn't enter off like something like this where I'm seeing market is being a bit consolidating a bit, yeah. But if you had to take a trade, a sell would have been taking a trade, yeah, sell, yeah, at about 7 o'clock once it broke below there, and then you would have gotten the small trade there basically. You can go stop loss below maybe, yeah. Or if you wanted, maybe they even. So it depends on how you wanna go with that. I could target maybe these lows, yeah. And you got about only post what's the price here? 4, 5, 8, 9. You got about 70, 80 pips, which is not bad. But it's a small move, right? 80 pips, you can still make at least 120 rand of this on a 0.01 from this move here, right? So this is a small move that we got from the Fajr strat, but yeah, about 70, 80 pips from this move. Okay, so that's basically. Then of course we had the market structure shift. We broke above this previous highs. We had the fair value gap gets formed here. Look how simple this thing is, guys. Form there, take a trade off the open once we close above there, and there's another trade there for you. And then if you look here, okay, we fail. Then again, yeah, look, our market after the fair value gap. So it's pretty simple stuff, guys. Yeah, if you were looking for a liquidity sweep, look how the market reacted of taking out the London lows. Took out the London lows, went for the Asia lows. Once we went for Asia lows, what happened? Inverse fair value gap, take a trade, inverse fair value gap, target the highs, done. Done. Smashed it there. Right? Guys, gold is not difficult to trade. I'm not sure why people will tell you that gold is difficult. Right? So inverse fair value gap taken. Sorry.
That is good. It's really good. No, just
I see someone in the chat here. Yeah, I have a YouTube channel. How do you close half your profit on 0.01? Okay, so you can't really close 0.01. That's like the lowest lot size. But you can, what you can do is go switch to a cent account. What I'd recommend if you have like, if you're going to be trading with 0.01, rather you trade with a cent account than trade with 0.01, like opening 0.01. That way you can open like bigger lot sizes and you can easily spread out your trade, right? So if I'm opening like a one lot on a 0. Opening one lot on a cent account, at least I can close half my trade, right? I can go maybe break even quickly. So I can go break even. I can take half the profit once we go into the 50, 100 pips, whatever. I can leave runners as well. So if you're trading with a 0.01, just 0.01, rather you go and trade with that cent account. Nothing wrong about trading with the cent account. And for those of who are trading maybe 0.02s, okay, that's fine. You can close one trade once you go to hit like a certain amount of profit, then close the other trade at break even, right? And of course, if you're going to be but if you trade with a 0.01, rather you just go cent account. All right. Okay, so let's move on. So I showed you guys this was Thursday. Friday, we are bearish, right? Okay, so unless we break above here, which we do kind of break above there, so we broke above the previous high, and that's your market structure shift. So we can start looking for buys here, right? Market structure shift occurred. Okay, and you can see a fair value gap here. Wait for market to tap into the fair value gap, which we did tap into it, and it got this move back up here from how many pips is this? 4597 to basically, so we're 50 pips here. Then if you look here again, if you wanted to take this trade here, okay, there is a trade there as well. Then I also see a trade here, possible trade right here. Inverse this gap here. Okay, we swept these lows and we did the inverse with value gap. Still within our time frame that we're looking at, 6 to 8 o'clock in the morning, right? And you can take a trade there. So look how we went pushed up from there, right? So this was Friday, and basically the week is done. Okay, so yeah, guys. Anyone has any questions? And look at this, guys. When once we had a big sweep like this, right? Obviously, if I'm looking at something like this, right? If I look at a market pushing down like this, what I want to look for is a market sweeping important lows, right? What I'm talking about important lows, I'm talking about your Asia lows, your London lows, your 4 hour lows, you're looking into tapping into like in 4 hour fair value gaps, something like that. Right? Tap into a higher time frame fair value gap, right? So that's how I can catch my reversal trades. I know a lot of you, what you're gonna do is you just see it pushing up a little bit. You go on a 1 minute time frame, right? You go on a 1 minute time frame, then you think this thing is gonna buy up, so you just start taking buys from there. Once you see it weakening slightly up, you start looking at, okay, let me take a buy, and then you get cooked, right? Even on the 1 minute time frame, some of you might have seen this here that's happening here, and you think this thing is gonna go down, right? What you need to do is you go on to like a 4 hour time frame like this, or even a 1 hour time frame is good enough, right? Let's go here quickly. Let's put this off. You go into like a high time frame. Oh, this is it. Oh, there we go. All right. Look for. All right, there we go. There's your fair value gap there. All right. Mark this shit out. Going back into your 5 minutes or whatever. See, guys, look at this. Tell me, tell me we can't make this shit up, right? Look at this. We tapped into the 4 hour fair value gap. Okay. Then what happened? We reversed right there. take your trade here, inverse fair value gap. There's your liquidity sweep tapped into a 4-hour time frame. You had your inverse fair value gap, take your trade, they're done. You got yourself, and this signal was sent also on the VIP group as well. By the way, I did take a loss first. My first loss was taken on Friday, somewhere around here or something, right? We did take a loss somewhere here, and then I think we did catch this trade here, right? And there we go. Take a trade, done. Catch a reversal trade. Don't think it went all the way up there. Stop loss can go here. Okay, this is about 1,000. That's too big. Let's go for maybe normally I'll go with the stop loss of maybe like 100 max, 100 pips max. So we're entering at 4,571. So 4,561 is maximum what I'm looking at. So okay, let's just say maybe just below this gap here. If you have a fair value gap here, right here. If you see right here, there's a fair value gap here as well. So maybe just below this dark handle here, right? That can be a fair value gap. Take your trade done. You basically caught yourself a reversal trade, and you can go. I can go maybe like 100 pips or something. Maybe even a 1-to-1 or something like that, right? Very simple stuff, guys. Very simple stuff. Okay. So, and of course, you can go into a lower time frame as well if you want maybe like a more precise entry. Maybe even like a earlier entry. Okay, basically the same thing. Okay, so if you go here 1 minute time frame, basically your entry would be there. If you entered off this inverse value gap here, tapped it there, boom, taking your trade there. All right, so that's how you can catch reversal trades. Okay, and this of course will work on anything like Nasdaq, US30, German 40, anything. I'm teaching you guys stuff that will work for everything. And by the way, this is stuff that you guys people will charge you a lot to learn this sort of stuff here, right? So and here we're giving you guys for free. So you guys need to go and backtest this thing. Don't take advantage and just say that, okay, I learned it now and I don't need to go over it again. Okay, because I know a lot of people, because they're getting for free, they're not going to put in that effort. They won't put in that effort. But if they were paying for this thing, they would obviously go make sure that they're learning, make sure they're getting full use of their money and all of that. But yeah, we're giving you guys some stuff for free. Some people will charge you 15,000 rand for mentorship, 20,000 rand for mentorship. Basically the same thing. They'll be teaching you all this stuff here. But yeah, we're teaching you for free. So guys, the main thing is you guys gotta go put in effort, go practice it, go learn on yourself, go. I just went over 1 week, right? Every week I'm just gonna go over the one week of trading, the week that we passed of trading, and then from there you guys just go practice it. Go try maybe US30, Nasdaq, go try trading on these ones as well. Okay. There's Bitcoin as well, but I wouldn't recommend trading Bitcoin weekends, mainly because the spreads are horrible. So use that time to go backtest on the gold instead of trading Bitcoin or whatever. But yeah, guys, that's pretty much it. If you guys have any questions, let me know. Market has to respect all the FEDs. No, the thing is, right, the market, if you want to take a trade, right, it doesn't have to. The market is gonna eventually disrespect it, right? Will disrespect the fair value gap. Okay, market is gonna eventually disrespect it, but right, it's like spaces like this, right? I wanna see market respect this fair value gap, right? When we created this 4-hour gap here, what I wanna see is market respect it, and it did respect it. It broke above, and we respected it, right? Okay, if I'm looking at these, where I want to look for a bullish fair value gap, I want to see market respect it like this. That's your gap there, right? Okay, I look at market, I want to see market respected it there, take your trade up there. Okay, so that's basically if you're looking for if your bias is bearish, right, then I want to see these fair value gaps get inversed all the way down. So I want to take the sell down. I want to see all these gaps get inversed. Okay, so yeah, any other questions, guys? Is it advisable to take only one position? I would say so. Take one position, one big size profit, and then you're good then, right? It's easier to sort of monitor that trade. Okay. Because now if you're gonna be opening like 100 0.01s, okay, maybe you're not gonna open the 100 0.01, I'm exaggerating. But if you're opening like maybe 20 0.01s, right? It's difficult to monitor and put stop losses on all these all of these 0.01s, right? What are you gonna do if market just shoots down, right? And this like maybe you might forget this news or NFP, you're in buyers here or something, you enter buyers here, market just explodes down. What are you gonna do then, right? You're gonna lose more than what you expected to. Okay, so yeah, guys, it's best to have one trade. You can monitor, it, put a stop loss, easy to put stop losses, and you know, yeah. So yeah, any other questions, guys? Everyone's all good. Everyone all good, guys? All good. Okay, perfect. Okay, so I'll send you guys this video. I'll try and send you guys tomorrow, whatever. Then yeah, we move on from there. All right, salams, guys. Hope you enjoy your week, and yeah, see you guys next week, Sunday, same time.